Good morning, traders. It is Friday, September 19th. A few interesting things to cover this morning and go into some details about the strategy as well and account sizes. But let's jump through the markets first. Equities today are set to open higher. We've got the S&P 500, NASDAQ, and Dow slightly positive. Again, when we look at the S&P 500, we got this Fibonacci move. The market is primed and ready to run about 4% and about 5% for the NASDAQ. So we got some upside potential here. Again, we've got triple witching today, which isn't a huge deal. It is for a lot of people who hold a lot of options. But other than that, it shouldn't really shake the markets up too much. It can drag things around or cause it to be fairly stagnant. You really never know, kind of like every other day. But overall, if you're an options trader, you might have some options expiring today. If we take a look at where money's flowing, so it is moving into equities today. We do have bonds like TLT moving lower. Again, giving up some of those gains recently based on Fed rate cut, and everybody piled into bonds and a little bit of profit taking now that that news is out. We are seeing the dollar trade higher again today. Nice move up over the past three sessions. Again, the dollar has been obviously in a downtrend, bouncing down. And depending on the currency you're in, obviously it's going to have a different type of chart or how it looks. The dollar making multi-year lows just 2 sessions ago, but today it's having a rebound. At this point, it still just looks like a bounce within a downtrend. The Canadian dollar, it looks like it's firming up, so it's different than the dollar index itself. But overall, dollar's bouncing. It's putting a little bit of pressure on metals. I mean, we're seeing gold and silver are both slightly positive. But the bounce in the dollar has put downward, a little bit of downward bias on gold and silver. They're taking a bit of a breather as money moves into small caps, micro caps, which we can see pretty well yesterday. If we look at IWC, this is the micro cap ETF. It was up like almost 4% yesterday. Big money moving into the small and the micro caps. If we look at the Russell 2000, fairly similar chart. Money moving into the small caps, big volume. And of course, if we go and look at like the Dow fairly dormant, big, large, boring sector. Everybody wants to get into the faster moving stuff where there's potentially more opportunity. So overall, if we continue down the chart here, take a look over at crude oil. It's down 0.6%. Again, it's kind of stair-stepping. It's way lower. No real interesting bias there other than it got into overbought territory a couple times over the past couple of weeks. One just a couple sessions ago, and it's kind of working its way down. Now, if we could just go back to gold for a minute here, I just want to take a look at gold's seasonality chart. Seasonality-wise, September, here we are pretty much, right in the middle, just the second half of September. We should see gold want to continue to push higher. It obviously has a bullish chart pattern on multiple time frames, which is good. So we should see gold move higher. That means the stock market may struggle a little bit, but they can rally together. This is what we saw back in 2007, just before the market topped. Gold shot higher and gold continued to rally while the stock market pushed to all-time highs. So again, everything is still in favor. We're long gold with a discretionary trade, a side bonus trade if you follow me with those. And overall, if we take a look at the S&P 500 seasonality chart, we're kind of in a time where the S&P 500 struggles. Now, this doesn't mean it's going to go down. I've seen the stock market do the exact opposite all year. So this is just on average. The stock market is struggling a little bit. It's kind of got a bit of a headwind in terms of where it should go over the next month, which is naturally there's going to be some selling pressure going forward. And of course, if we look at the sentiment chart of the S&P 500, we can see the sentiment chart has this, it's showing red signs here. It's got a pretty interesting price action that it's not the strongest sign. We actually hit a target this week in the SPY, locking in some gains, reducing our exposure. If we look at the long-term sentiment chart, we're in this phase very similar to earlier this year. January, February, we had a similar type of move. The stock market rallied up. We had this move, and then we went into a very big sell-off. We could be getting into something close. As most of you know, I'm pretty bearish, thinking that something big is going to happen. Eventually, I do think we're going to come back down, test these lows, and I do feel eventually we're going to break them, but that does not mean we bet against the market and we start buying inverse ETFs and skip trades to the long side. We want to be long. We've played some very nice trades to the upside. Our counts should be, if you've been with us for a while, hitting all-time highs and moving up here. Let's take a little look at real estate real quick. So we have got the IYR Real Estate Trust. this is a way to play real estate, especially if you want to be more nimble and get in and out of real estate. And if you have smaller, you don't have the capital to invest and buy, multifamily buildings or whatever it is you want to get into. Real estate ETFs are a great way to do this, but keep in mind the real estate ETFs move like a stock. They don't move with home prices, but they do allow you to get involved in the real estate market. You can buy, overall real estate. You can buy self-storage. You can buy all kinds of different types of real estate. The nice thing about REITs is they pay really nice dividends. The only catch is they can drop. Obviously, home prices don't fall 43% in 2 weeks, but the REITs can. They are volatile. If we go back to 2007 and we had the market top, we saw REITs fall roughly 77%, which means, to get back to break even, you need to make about 300% return, which is pretty darn hard. It takes a lot of time and you really have to just ride it out, which is a lot of wasted time. So overall, I like the real estate space. And when the time comes for real estate, we'll be involved probably with the real estate ETFs. I'm big into self-storage. I own a self-storage facility myself for long term. It's like a cash machine. But kind of where we are right here and kind of right here, I do feel like is kind of like over here. Meaning I think at any point here, we're going to see the stock market go into a reset. It's going to pull the REITs down with it because, hey, this is more or less a stock in the stock market. And when people panic, they sell. And when we have this getting into REITs, when the stock market has been beat up and oversold and you get these big juicy dividends, it is a huge opportunity. So we'll keep our eyes peeled for that when the time comes. This is still probably a year or two out, but it is a great long-term play with big returns. If we take a look at real estate in southern United States, we've got more supply homes for sale right now than we did in the 2006, 2007 housing bubble. And I know there are tons of subdivisions that are still being built that are kind of actually, a lot of them are stuck and stranded. They can't sell anything. I know some people who got involved with subdivisions and the investors literally walked away. They only wanted to lose a couple million versus like 30 million. They just gave up on it. And that means eventually we're going to probably see the housing price unwind once, sentiment and money flows and unemployment really turn a corner. This is an interesting thing I saw just the other day here. A quarter of U.S. consumers are now financing groceries with a buy now, pay later as economic pressures mount. That is insane. Usually you do that when you buy like an ATV, a dirt bike, a boat, a RV, whatever it is. But here people are putting off their groceries. Obviously, this is probably not somebody investing in the stock market because they don't have money, but this pocket of people will slowly grow, and this is just the tipping point early that there's a lot of pressure in this market. Now, I do want to touch on something really important. We have this is from a member comment and experience recently. So with the ACS strategy, which is our adaptive compounding strategy, the returns are slow and steady, but they compound on top of each other, and it can generate some pretty good average annualized returns. Again, some years are going to be big returns, other years are going to be small returns, some are going to be average, and that's how you get the average annualized return. It doesn't mean every year is going to be big. Now, we have a member here concerned. We're up 2.2% or over 3% now on our position. And people with a smaller account size, and I'd say a smaller account size is $100,000 or less. With a smaller account size, sometimes you need to use more leverage. You need to get more juice out of it because there is a subscription fee. So this person is talking about how they haven't made their subscription fee back. They're up. This was a couple of days ago. They're up 2.2%. We're now up 3%. But overall, they haven't covered their subscription fee with their account, which is around $100,000. They're very disappointed, very upset. And they're confused about the trade. So I want to touch on a couple of things. First of all, if you have a smaller account size, 100K or less with the ACS strategy, you may need to use 2X ETFs because now your account is acting like $200,000 and you get a lot more juice. You can get more return to cover any subscription fee and still have a decent amount of gains after that. I know a lot of you are using the 2X and some of you are using 3X in some cases. And again, you can do whatever you want. I provide the most solid, stable, easy to manage, low emotional strategy, and you can amp up the leverage as much as you want. Some of you trade options on this as well. So Again, depending on your account size, you have to figure out what is best for you that make the numbers work. Just like in real estate, you don't buy a house during a bubble and the numbers don't work. You need to do the same. When you move to a strategy, you got to make sure the numbers work, and you need to apply the proper trading vehicle, 1x, 2x, 3x, however, if you need to. I try to steer away of leverage myself, just because I've been burned in the past, and I'm not trying to swing for the fences, and I don't need, if you have 2x, you can make twice as much, but when you take a hit, it is also twice as much. So you have to understand that part. There's always a trade-off when you go for leverage. So a good example of this is, if you've got a smaller account, you should be covering with up 3% on our position, you should be covering pretty much your subscription cost should be pretty darn close on this first portion of our trade. But for example, this trade that we're in right now, I'm up over $100,000 in my account with our ACS strategy. I know some members are up 300. I know another one's up over 400,000. And this trade isn't, a huge mover, but there's some big money being played with some of these accounts. So account size makes a difference. Now, the other part that this subscriber is concerned about, they're confused. They don't understand to follow the trades. They don't understand to separate updates. Now, so I want to keep this really clear. When I send out a video analysis, it doesn't matter what, it doesn't matter if it's a ban update or if it is a ACS update. The stock market is the stock market. My analysis doesn't change. It's the same. So a video update caters to everyone. I'm explaining what's going on. The only thing you need to segregate is when we have a trade alert, if it says ACS and you're trading and just focusing on the ACS strategy, then you focus on this. If it says ban and it has the ban trade alerts and you're not trading ban, don't trade them if you happen to get those for some reason. If you've got the bundle package, you just follow the trade alerts for the strategy you're using. Now, this person has got confused with the ban hot list, saying we got into the ACS strategy and how it was saying risk off for the QQQ, even though we got into this. And I did address this in the last mentoring session. Don't follow, the ban strategy, and these signals are alternate signals. They're not what powers the ACS strategy and our overall signals. So the key is when we have a buy signal and I issue a trade alert is because everything meets the criteria. Don't go looking at other stuff and saying, well, this says it's risk off. Why do we have a buy signal in it? And things like that. So try to focus on the strategy that you're following. I know some of you are doing a blend of 2 or 3 or 4 of our strategies. And if you are doing that, make sure you've got like a log and you're keeping track of how much money you're allocating to each strategy, your positions. You do need to focus and manage your side of things. But from the standpoint of these trade alerts, simply, if you're following our adaptive compounding strategy, just follow the trade alerts. We tell you our current position size, what it'll be done after the trades. It tells you the trades to do in order, how much of your portfolio allocation, like when to enter. Once we get into the trade after this, we send out another update with our new portfolio allocations. We've got our entry prices. We have the tables with each position, our entry price, the day our target pricing. Everything is here. It's easy to get overwhelmed because it's a lot of info, especially if you're new. I know members have been with us for a while. This is just routine. Just take it one piece at a time, especially for the trade alerts. Read it, see what we have now, what our goal is after these trades, our goal portfolio, and then just follow each trade at a time. And then eventually we end up with our portfolio of these positions. So anyway, hopefully that gives you guys some insight and understanding of how to follow our strategies and all of that, and how position sizing, or more so portfolio size, does play a role. There's a reason why people with smaller account sizes are always into options, into small caps, micro caps. They need bigger movements to move the needle, to make it so they actually can make a good dollar value return. And with a strategy like ACS, if you do have a smaller account, which I would say 100K or less, you may need to use the 2X ETFs to get more juice out of it until your account maybe is $200,000 or higher. And then the numbers work really well. Obviously, from a dollar standpoint, the trades make a lot dollar-wise with a larger account. Anyways, that's it for now. Take care. Bye-bye.